Steve Brice, Chief Investment Strategist at Standard Chartered Bank, joins us on the program. Steve, good to have you back with us. So what about the rally that we're seeing on the markets? Is this going to continue for how long?
I think if we're looking over the next few months, we still think this rally has got legs. But I think in the short term, what we're seeing is, if you look at our risk appetite index, then we're at now highest levels since around 2010, so summer 2010. So our concern is that we may see a little bit of a short-term correction here. Obviously, we've got a major decision coming out of Europe on Monday, and that's going to be very critical to see how that plays out. It's clear that Germany is playing a little bit of a hardball with Greece, so it's not a foregone conclusion that that will be ratified at Monday at the earliest. So from that perspective, we're probably looking at an 8-ish% correction in equity markets before we consolidate and then start to move higher later in the year. And so that's the sort of the general environment that we're seeing at the moment.
Okay, and your picks are more in Asian emerging markets than developed ones. So you said China is your top call. What are you seeing there?
Yeah, I mean, look, China is our top call if we're looking at a 12-month plus perspective. I think we've still got to get the Chinese authorities to get the economy, or the weakness of the economy, number one on its agenda to try and address that. They're still obviously still worried about the property market outlook, so the bubble that has been, it's bursting at the moment, but they're still worried about reigniting that. They're still worried about inflation. Obviously, the latest inflation data ticked up a little bit, so that might delay them in terms of the really going wholeheartedly into stimulating the economy. But once they do that, we believe the stock market will respond very favourably. We've had credit data slow down this week, but overall, we do think equity markets are cheap still, despite the recent rally. If we're looking at what they're pricing in from the banking sector, we think they're a little bit too hawkish. So once we get that stimulus coming through, we believe Chinese equity markets will outperform in a significant way.
And I guess because of your belief in global stimulus, that's why you like gold. In fact, you like gold-related companies in the equity space. And this is a hedge against, I guess, imminent inflation. Is that what you're looking at?
Yeah, so I mean, we like gold from two perspectives. Obviously, protecting against inflation, we do see central banks having an asymmetric policy response against deflation versus inflation. So I think that's been seen consistently across certainly the US and UK. Europe, obviously, in December joined that party, and then this week we've seen Japan even inducing an inflation target, obviously a modest one at 1%, but that's a fairly significant development psychologically, we think, for the Japanese authorities. So hedging against inflation, gold and gold equities, we believe, is a pretty good place to be overweight at this time. Just one short-term issue is that Bank of Japan's decision this week to pursue quantitative easing. I would have thought we should be, if the gold market wanted to go up, that was a good reason to push it up. The fact that we didn't see a major reaction to that, we could see gold coming down to 1650, 1680 in the short term, but we'd see that as a buying opportunity.
Okay, so it sounds like a buy on dips is your call. Steve, have a great weekend. Thanks for sharing your time today. Steve Brice.